Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Monday guest, Mr. Greg Dickerson. How you doing, sir?
Doing fine, Michael. A little bit of a cold, but I'm getting through it.
Oh, you sound great, man. It's a very deep, almost baritone, I think is what they call it. It's yeah, it's very cool. Well, anyways, this is the episode I've been looking forward to getting to because, again, I like to be positive whenever possible. First two episodes today were kind of downers, kind of reality looking where we're at, headwinds, drop in the market. But
I wouldn't call it a downer. I would call it accurately assessing risks, because as a prudent investor, as a sophisticated investor, you always need to understand risk, because what's the number one rule of investing? Preservation of capital. Warren Buffett, don't lose money. That's what he was talking about. Preservation of capital. You've worked hard for what you have. You need to keep it, right? Anybody can make $1 million. A fool can make $1 million. It takes a genius to keep it. So
there you go.
So that's not negative talk. It's not being bearish. It's talking about what's really happening in the economy and what you need to be aware of and understand so that you can accurately calculate risk, understand the risk, and hedge your bets against that, and then be able to react and respond. Or you can just be diamond hands and hold forever and hope you come out okay.
Yeah, I appreciate that lens. That is very good. As we get into this environment, and let's assume we have a downtrend like the dot-com crash, it's not sudden like the pandemic. It's quarters, not a year in the making or years. There will be opportunity. There always is, right? As you've said many times on our shows, it's better to know the top than the bottom, but there will be a bottom, and there will be assets that are unfairly punished. Perhaps people give up, and there will be opportunities, right?
Yeah, there always is. And it's always cycles. So the dot-com bubble, that, as we looked at, that was several months that took to get to the bottom. The great financial crisis markets, it took several months for the markets to bottom. It wasn't straight down. Mm-hmm. There were a couple of little capitulatory events, but March 2020, that took a couple of months. It wasn't straight down. Mm-hmm. So you always have time to understand what's going on and react. And, the real estate market, when things slowed down 04, 05, that was pretty easy to spot. So I'm no genius. How do you spot a market top in real estate? Well, number one, all of a sudden, just like now, there was very little property for sale. Okay. Back in 04, 05, before the peak, you couldn't buy anything. There was almost nothing for sale. There was very little inventory, and anything that would go on the market would sell quickly. And there were multiple offers, lots of demand. Mm-hmm. Then all of a sudden, two things happened. One, my phone stopped ringing. I was a builder, and I used to get multiple phone calls all day, every day for all kinds of different work. My phone stopped ringing. Nobody wanted to spend money on houses. Nobody wanted to build houses. The second thing was, for sale signs were popping up everywhere where you couldn't find one before. All of a sudden, it was a forest of for sale signs. Yeah. Okay. So that was easy. Something's going on, and markets were peaking. As far as stocks and things like that, same kind of thing. When you start to see sentiment in the market change, and you start to see the direction and the momentum in the market change, it's all about cycles, that you're in, ranges, and then trends, and you just look at the trends, and they're pretty easy to spot. Same kind of thing. So your opportunities are going to be, if you're a trader or you're swing trader in the markets, understanding that and getting in and out, because on the downtrend, when you look at those big drops, man, there's big bounces along the way. I mean, 20-30% bounces. So you can make a lot of money moving in and out of those things if you're careful and, catch those. And you can make, on a 30% move, you can catch 20% of that pretty easily. You're not going to catch all of it, but you can catch 20% or even 10. And, just to put that in perspective, if you have $1,000 and you make 78 trades that you earn 10% on, and you reinvest all of the profits and compound that investment, you'll have $1 million at the end of 78 trades, making 10% per trade off of $1,000. So that's the power of trading and what it can do for you if you keep it in there. And then real estate's the same way. You buy at the bottom, and, you can get more income for the dollar. You can, buy and resell when the market rebounds and things like that. So, there's always opportunities. And for me, when it comes to the markets, the first time I bought stocks was at the bottom, March of 2009. Never bought a stock before that. That's when I started investing in stocks. And, same thing with crypto. I started studying the crypto market, kind of watching it 2015, 2016. Mm-hmm. I didn't buy my first one till 2020 at the bottom, because, you can identify these trends, and that's where the money's made. The money's made at the bottoms of these cycles, and you can make money trading along the way. But, I'm not a day trader and a swing trader. Haven't been. I've done more of it here in the past year because these markets are bouncing, as they're going down. Yeah. So I've been doing a little bit more of it and having fun with it. But there's always opportunities in every cycle. And again, good times never last, bad times never last, and there's opportunities along the way. You just got to understand them and be careful and know where you entered, where you exited, what your risk is, risk reward, what's your potential upside, what's your potential downside. The biggest mistake investors make, most investors make, I made it before 2004, 05, and 2008, 9. I thought markets did nothing but go up. I didn't think they were ever going to come down because it just seemed like, man, just everything's great. Real estate's limited, value's only going to go up. They ain't making any more of it.
Yeah. When I look at kind of taking action at the bottoms of markets, one of the things that I appreciate, and I think we talked a little bit about it, episode number 2, is I actually like to see where a lot of the newbies are running to pre-crash, right? Because I think the last hurrah of any market is the newbie coming in, right? The professionals are leaving, the newbies are coming in, they're buying at the top, and it is those people that buy that will become eventually the people who give up. They sell at the bottom. Capitulation is often called in the stock market. I think the same thing exists in all assets. So when I look at what's going on in the area that I look, real estate, there seems to be more people investing in commercial today because bigger is better. Got to have the big stuff. Classic Grant Cardone saying, but there are hundreds of people, if not thousands, doing it now. And then you layer on top of that the bad debt structure. It still amazes me that we're repeating the same sins, just in a different asset this time. Why did the real estate market get so bad? Because the last hurrah, everybody assumed real estate went up. These exotic mortgages came in, 2 and 28s, where the first 2 years it was 0.9% interest. Then it resets to 9 or 10%. And the whole idea was you're going to refi out. I see the same kind of nonsense going on in commercial today. So, and then it's not in residential. Residential lending is probably the strongest it's been my whole 21 years. Got to have income, got to have a down payment, 30-year fixed rate debt, 2% of mortgages are adjustable rate today. So when I look at what might be coming in the next year, 18 months, it's resets, reevaluations, higher cap rates, value add opportunities that turn upside down. That's where I see the greatest pain.
Yeah. And what's really interesting is there are going to be a lot of mortgages in place that have great long-term loans and interest rates that you can step in and take over, because some of these properties might go upside down and somebody just needs to move or whatever and isn't able to sell because of their basis. So there's a lot of people that are buying now at the top, absolute top of the market. Let's say they have to move, whatever, and they want to go sell their house and they can't because the market shifted, and they don't want to take that kind of loss or can't take that kind of loss. Where if they have a good long-term loan with a low interest rate in place, this applies to multifamily as well, because a lot of those loans are assumable. You can just step right in and take the loan over, take the property over. Not like you can just take over payments. It's called a subject to, where you take title of the property, the loan stays in place, and you make the payments. But you'll see those types of transactions come back, and that's that works in the commercial world as well as the residential real estate world as well. Yeah,
it's very interesting you bring that up, because there were in the last crisis, you're right. There's a lot of commercial loans that are assumable. Usually there's a 1% assumption fee or whatever they call it. It's not very common in residential. Obviously, that was something that they changed in the 80s. But yeah, I think subject to is going to become a thing both in residential and commercial, right? In residential, I think we're going to have a recession. Go back and watch episode 1. And out of that will be job transfers and, hey, I got to move from here to there for a job or whatever. And there's going to be a lot of folks with 2s on their 30-year mortgage that will be very sexy to go get.
Yeah. And like I said, they'll be trapped, because if values drop significantly, they may not want to take that haircut, and you can come in and offer them full price. Say, look, I'll make you whole. I'll pay you, the balance of the loan or whatever, make any kind of deal you want. Just take over the payments.
No, I believe in this next recession that one of the outcomes is going to be subject to is going to be the thing to learn. Something I've never done other than that one loan, but that was directly with a bank, not a seller. That's something I have to learn is subject to, because I think the next recession, unemployment goes from 4% to 8%. The consumer is going to get scared. And that's all I track is the consumer. They're going to get scared. They're going to stop spending. I mean, that's the market, right? So it's a demand driven economy. It's a consumption based economy. And when consumers are buying, the economy is doing good. When they're not buying and they're not feeling good, economy doesn't do as great. So that's what you have to track is consumer spending, because that's what drives the economy, supply and demand. Yeah, consumers are very interesting because there's two metrics, right? Often there's sentiment, which is forward leading indicator. It's kind of what they think. And then there's retail sales. Retail sales is what they're doing. And sometimes they're bipolar, right? They're all scared, but they're still shopping. And we saw a little bit of that in January. But yeah, I think there's a lot of things out there that are going to get interesting.
Well, that's anything. That's what I say with the Fed, within, investment funds, investment banks, hedge funds, people that are speaking their book on CNBC. It's not what they say, it's what they do.
Mhm.
Don't watch what the Fed is saying. What are they actually going to do? Because they've been talking for the last couple of months and they haven't done anything. And look at what the markets, how they reacted.
Yeah.
So consumers might feel bad.
Right.
Okay. They might be concerned about the economy, this, that, and the other, but what are they doing? They're racking up credit card debt. I don't know if you track that, but credit card debt at the household level is higher than it's been in a long, long time.
Yeah, it's almost a record. It's jumped noticeably in the last 6 months for sure. Absolutely.
Yeah. So people are feeling the pinch because their discretionary income's been, hurt with inflation, and people that are on limited budgets, just daily living has gone up through the roof. So they're subsidizing that with credit card debt, hoping that it will subside soon, because what is the Fed and what is the government telling them? Oh, it's transitory, it's temporary, it's gonna, it's peaked. The latest news we saw was inflation's peaked.
Yeah.
And I haven't seen anything peak yet. I see it's just getting worse.
No, yeah. We talked about your gas going over $3. It's $5.49 where I'm at this morning or this afternoon, whatever. Yeah, it's not good. So again, I did the calculation. So the last CPI was 7.5. I backed out their bogus rent component, which was 3.2 or 3.4. I put in 14.8, which was the last reading on rent, and CPI is now 10.2% with that one correction. Now, obviously, there's lots of other corrections you could do, but just correcting rent, which is 28% of CPI, 10.2%.
Yeah, it's pretty amazing, and we have fascinating times ahead of us. And if the Fed can't get a grip on this and start, and that's the other thing, it's going to take time. So they can come out and raise rates 1%. That's not going to change the inflationary environment for a while. It takes a little while for that to kick in. It might change markets and assets and things like that. It's not going to change real prices at the consumer level.
I think that's a very important point. The Fed comes out, surprises the world, and it raises a full point, 100 basis points. The stock market won't be happy. It will not be happy.
Who knows? It might shoot up going, what are these guys? What are they thinking?
Yeah.
Is this really the Fed?
Yeah, that's right. Oh, anyways. But I think your point about inflation, even if the Fed goes up 200 basis points, inflation, the economy is a complex thing. It will take months and quarters, because what will happen is cost of debt, cost of money will go up, consumption will go down, unemployment will go up, consumption will go down. And it could be 6 or 9 months before you get the real rollover.
Yeah, just like real estate, you could drive interest rates up, full 2%. It's going to take, 6 months for that to cycle through the real estate market because of the seller's psychology.
Exactly.
The people that bought here aren't going to let go of that price anytime soon. It's going to take 6 months on the market of no offers for that psychology to change and trickle through the economy. That's what we saw the last time, the 04, 05 peak. Properties had to sit for 3, 4, 5, 6 months with no offers before people finally realize, well, maybe the value isn't where I thought it is. And then comps start coming in because people start taking less, and it takes a little bit of time for these things to shift. So none of this stuff happens overnight.
Correct.
It's interesting, but markets react very quickly.
Exactly. Well, do me a favor, Greg. How can people find you?
Yeah, gregdickerson.com. All my info is there. YouTube channel, social media links. Go check it out.
Thank you, buddy.